Welcome back to the channel. A lot to unpack this week, a lot to talk about, especially with the Bank of Canada cutting for the third consecutive time in a row. That's 3 cuts, June, July, and now September, with the door fully open for an additional rate cut on October 23rd and even in December to round out 2024. The question is, how low will the Bank of Canada eventually go when it comes to lowering their overnight lending rate, that policy rate, in order to salvage the Canadian economy? How bad is the Canadian economy getting, and will these eventual rate cuts actually start to bring some life back to the Canadian economy? Now, this week we did get the rate announcement followed by the Bank of Canada Governor and Deputy Governor Carolyn Rogers' press conference. Want to take an opportunity to go through some of our thoughts and opinions, what we pulled out of this most recent conversation, and want to share it directly with you. But first, if you have not subscribed to the channel, we invite you to go ahead and do so. Don't forget to hit that notification bell and leave your thoughts, questions, and comments in the comment section below. Will the Bank of Canada continue to cut rates? Is the door fully open for the Bank of Canada to cut rates?
If inflation continues to ease broadly in line with our July forecast, it is reasonable to expect further cuts in our policy interest rate.
Now, ultimately, with all the data that we see sort of compiling right now, it does leave a lot to be questioned in the sense of, where's the Canadian economy heading? What's happening with growth? What's happening with jobs? What is happening with these immigration level wages? So many different components that the Bank of Canada is paying close attention to. And those are very important data points, but the most important one that the Bank of Canada pays really close attention to is obviously inflation, CPI headline inflation, core, medium, and trim, those preferred measures by the Bank of Canada, ones that they pay close attention to. Well, for the month of July, that came in at 2.5%, and ultimately with those numbers retreating back from their highs that we saw just a year ago, that does give the Bank of Canada the cover it needs to continuously cut those policy rates, which I believe the Bank of Canada knows is in restrictive territory, meaning they're too high. They may have increased rates way too much, especially with those last 2.25% increases that we got not too long ago. I think those were maybe overkill, and the Bank of Canada is now trying to really evaluate, rebalance the Canadian economy. Now, obviously this comes on the tails of many economists, many analysts' conversations stating that the Bank of Canada literally took the Canadian economy and made it grind to a complete halt. And although there are some signs that the economy is still alive, it's basically not firing on all cylinders, and we're having some major concerns. But the Bank of Canada governor came out right off the hop, obviously with his prepared remarks, talking about how inflation is pulling back. They're confident that inflation will get back down.
Our decision reflects two main considerations. First, headline and core inflation have continued to ease as expected. And second, as inflation gets closer to the target, we want to see economic growth pick up to absorb the slack in the economy so inflation returns sustainably to the 2% target.
And they're really aiming for that 2%. Now, it won't always be at 2%. There's going to be, as we've talked about on the channel, multiple, base year effects, different challenges.
It is to reflect the push and pull of opposing forces. Overall weakness in the economy continues to pull inflation down, but price pressures in shelter and some other services are holding inflation up. Since the July NPR, the upward forces coming from prices for shelter and some other services have eased slightly. At the same time, the downward pressure coming from excess supply in the economy remains.
When we talk really about those push and pull factors, I mean, right now, if we think about the, push factors for inflation, what's keeping those inflation numbers high, and, most Canadians are fully aware of it, is the shelter cost, right? The carrying cost of mortgages, rent, and upkeep on homes. These particular nuances are driving inflation higher, and this is keeping those numbers elevated. So the Bank of Canada has to really focus in on how to bring those inflationary pressures down. And well, with the fact that the Bank of Canada is now signaling a major pivot where they're in a rate cutting cycle, I believe this is where we're headed, especially with the US signaling that they are now going to participate in cutting rates on September 18th. Well, this gives the Bank of Canada that cover to continuously cover rates. Now, it was expected that the Bank of Canada was going to cut. I mean, there was no surprise to many Canadians that the Bank of Canada was going to cut. Many anticipated, hey, 0.25%, meaning hoping for a larger cut. And obviously a larger cut can signal more problems in the economy, right? The bigger the cut means that they're trying to play a game of catch up or trying to get ahead of something. Remember, we've talked about on the channel the proactive and reactive nature of central banks. So I do believe the Bank of Canada, as I said from the onset back in June, when they started to cut, that this was the right trajectory to go slow and steady. They actually can do this consistently because each one of these rate cuts that they introduce into the economy can take 12 to 18 months as a lag, right? There's a lag every time they do that. It can take some time for those impacts to bleed in to businesses, to business sentiment, psychology, consumer psychology, right? All this is very important. That's why the Bank of Canada really weighs in on the consumer survey and the business outlook survey, which we should be getting very shortly in the next couple of meetings. So, I mean, ultimately, all these data points compiled with the fact that the unemployment is at 6.4%. I mean, it's not historically high at the moment. However, if we think about unemployment, we think about how fast that train can get away from the Bank of Canada and snowball and how long it could take to reel that back in, while the Bank of Canada is sort of really approaching this slow and steady.
On the other hand, if the economy was significantly weaker, if inflationary pressures, if the downward pressure on inflation was significantly weaker than we expected, yes, it could be appropriate to take a bigger step.
And that's literally the sentiment that I got from the Bank of Canada governor, as he really said, look, as long as the data comes in, inflation aligns broadly with expectations, this is what we're expecting to do. It's not unthinkable for us to cut again in October and maybe in December, and especially in 2025, especially if the US starts to join in the rate cutting cycle. As their economy, obviously two different economies, they're experiencing some setbacks when it comes to their unemployment numbers. And as of Friday, obviously we'll get those numbers this Friday. At the time of filming this video, unfortunately, we didn't have that information. But if the numbers come in higher or lower, depending on how high or how low those new jobs are, well, that could signal to the US economy, obviously, some other directions in the regards of recession, that soft landing. If we see the job numbers come in a lot lower, it signals a bigger problem. If it comes in too high, well, that could change the course of the US Fed's decision whether or not to go higher or lower on that rate cut. But generally consensus is right now at least 0.25%. Now, why do I focus in on the US? Because for a lot of Canadians, obviously talking about rates, we'll talk about fixed rates, talk about variable rates. When the Bank of Canada makes its decision on policy rates, it impacts variable rate mortgages, those that are adjusted to prime. So if your bank, if you have a variable mortgage, they have a prime lending rate. If you have a line of credit, an unsecured or secured line of credit, it is based on prime plus. If you have, certain mortgages, they're based on prime minus a certain discount factor. And that Bank of Canada policy rate decision actually impacts those types of mortgages directly. So it's important to really understand these types of products and what they really mean for Canadians, especially as we get into this rate cutting cycle. We get asked all the time, man, what are your thoughts, fixed, variable, what should we do? And ultimately, we'll have this conversation. We are going to be doing a fixed variable rate mortgage rate update in the coming weeks ahead as we get some direction on where fixed rates are headed. But as of right now, they have been pulling back. Banks have been talking about these rate wars, these conversations about where rates are headed. And as a lot of the banks begin to participate, especially, most of this has to do a lot with renewals, right? Because the mortgage market, the real estate market has really slowed down. So the banks are looking for ways to open up opportunities, and these are mostly happening with renewals. So we'll talk a little bit more about that. I'll save that conversation when we get into the rates and where things are headed there. But I think really the question is around the mortgage and real estate environment with this most recent change, this most recent 0.25%. Now, we've talked about in the past, obviously 1 to 2 rate announcement, 2 cuts isn't going to move the needle for many Canadians. I mean, I think a lot of the conversations that we had with real clients is they were waiting for this third and potentially the fourth cut in order to get them off the sidelines. Now, by no stretch of the imagination am I saying to our viewers, our clients, that you need to get out there and buy a home today. Absolutely not. You have to do this when you are ready, when you've balanced your budgets, you've looked at your finances, been pre-approved, and are willing to stomach the volatility and obviously finding the right product. This is literally the reality of the situation right now. Nobody should be telling you to go out there and buy a home because you're going to miss the boat. However, you should be conscientious about how fast the market can change, because with the fact that, hey, look, Bank of Canada cut. Now all of a sudden interest rates are dropping. What will happen to consumer sentiment, that consumer psychology, when a lot of Canadians are chasing the exact same type of product? And by that we mean maybe you're looking at a single family home, a town, a semi. Maybe you're looking at a condo. Lots of condos available in GTA. Maybe not so in certain other regions of Canada. I mean, ultimately, are builders building the types of homes that Canadians want and need? And as the economy, the market shifts, it could take time to get the builders back onto the side, off the sidelines, back with getting permits, but this could take time, right? A lot of these projects can take years to get off the ground. And by that point, the amount of demand may pick up significantly, and we'll see exactly how that plays out. We're not saying that it is or is not, but I want to clip in here just to a quick conversation, quick question that was asked by a reporter to the Bank of Canada government when it came to shelter and home prices. Here it is.
So, yes, it wouldn't be surprising as interest rates come down, as activity in the housing market strengthens, you see some pickup in housing prices. We're not, we don't publish a detailed projection of housing prices, but that could well happen. But with mortgage rates coming down, hopefully with more supply coming into the rental market, with some reduction in population growth, you should see rent prices come down. So when I say, overall shelter price inflation can come down, I'm not saying that that means house prices are coming down. House prices could well actually pick up a bit with overall inflation in shelter price still coming down.
So ultimately, he's talking here about shelter, he's talking about home prices, and when he's talking about it is the correlation between interest rates and home prices. And if we start to see, interest rates drop, that's going to relieve a little bit of pressure in the shelter component. As interest rates drop, the carrying cost for mortgages should be reduced slightly. It's generally a consensus that if you have a variable rate mortgage, let's say at prime, which is now 6.45%, minus, let's say, an adjustment factor of 1%, you're sitting at 5.45%, as opposed to, 6-7% as we saw in the months past. So ultimately, this is going to change your payments by about $15 to $16 per $100,000. And with these last three cuts, that's about $48 to $50 per $100,000 that you would have seen as a discount or a savings on your mortgage, potentially, depending on the type of product. But I mean, that could add up to a couple $100 depending on the size of your mortgage. Oftentimes, a lot of our viewers are either entering the market or they're in the market or looking to find out more about mortgage renewals, refinancing, and purchasing. Well, there is a link to our free app in the description box below, and you can start playing around with what those payments could look like if you start playing around with some of the rates that are available on the app. And there's some great tools in there if you're looking to buy. So ultimately, go ahead, download that app. Use it to your own advantage to help yourself prepare for that mortgage renewal, or if you're looking to buy. And if you have questions, always feel free to reach out to us here at In Touch Mortgage Solutions. But ultimately, as I said, when you think about what he's talking about, home prices, well, we're not going to get to those pre-pandemic or those pandemic lows, I should say, where interest rates were super low, was free money. I don't think we're going to see that. And I mean, that was an anomaly that obviously for me and our business, we saw that driving a huge amount of people that were not necessarily looking at buying a home, but they had that FOMO and they ran to the market because interest rates were so low and anyone can qualify. I shouldn't say anyone can qualify, but most people could qualify, right? Those, if you had good income, you had some support, you had a down payment, you had adequate funds, resources. A lot of people were able to do things at that particular point that maybe they weren't able to do in the previous market. And it also took people that were maybe waiting to buy a home and drove them to buy a home sooner. So that is something that's very important to understand. But at the same time, if interest rates start to drop a little bit, now we're not saying back to that level, but just enough where we can start to bring in more and more people, I think it will slowly bring in more and more people as those interest rates begin to drop. If you're looking at a home that's maybe at the $1 million mark or below, and there's not that many of those homes available or that are coming to the market, well, and most people are looking at those types of single family homes because they have a growing family, well, then there's competition in that market. And if a home is priced right, it's appointed well, it will sell in any market. Ultimately, we saw that homes that were priced well, even when the markets were down, would still sell if they were priced right and well appointed. Homes that were not took a little bit more time. I do think the Bank of Canada governor sort of had maybe a Freudian slip. I don't know. Maybe he slipped up. He's saying, hey, home prices are, well, they're going to go up, right? Like if interest rates come down, that's an unintended consequence of what the Bank of Canada is doing. And as I said, take that as you will. I'm not saying to go out there and buy, but really think about it. If you're planning to buy, have you got your pre-approval? Have you got your finances in order? What is it that you're looking to do and how soon you're looking to do it? Because this could be an opportunity. Not saying that it is, not saying that it isn't. But as I said, the last thing you need to do, and the last piece of advice I would give, especially if you're looking and watching this video as a buyer, well, if you've got pre-approved, then you needed to put a financing condition in your purchase agreement, and there's no way for you to go about not having that financing condition for at least 5 days or 3 days, and you need that to go out there and buy a home. Well, you have to consider the market. If the market allows you to put that condition in now, get your home inspection, so on and so forth today, it may not allow you to do that tomorrow, and slowly you get priced out, because once again, you don't know who you're sitting against at that table when you are making those offers, and if those offers are coming in, how deep the other person's pocket is. So always consider those things. If you have questions about your mortgage, about your refinance or purchase, need a pre-approval, feel free to reach out to our team. We're always happy to help. But until next week, we'll leave the video here. Wishing everyone a wonderful Friday and an even better weekend ahead. Thanks for stopping by.